What's up, guys? Welcome to another episode of Maslow's. As a result of the lowering of inflation, we may be seeing the start of a 2023 bear market. It was recently revealed that more than a third of small firms were unable to pay all of their rent in October, that half of the workers anticipate layoffs, and that the Federal Reserve is just 3 weeks away from another rate hike, with more to come. That's why, with everything going on, from the dropping of home prices to the growing consumer debt and interest rates, we'd like to weigh in because, as it turns out, there is a historically proven strategy to invest if you want to benefit from a market like this. Hi again, folks. Welcome to another episode of Maslow's. And in this video, we're going to talk about the strategy for the 2023 recession. First, let's define what a recession is. A recession is characterized by 2 consecutive quarters of falling GDP and can have a wider impact than just damaging financial markets. Based on historical data, there have been 18 recessions in the United States since the 1940s, with varying lengths ranging from 2 months to 18 months. During this, we tend to see negative consequences such as job losses, declining wages, and less private investment. However, in comparison, a recession has a relatively small impact on the stock market. In fact, from 1869 to 2018, there were 16 recessions with positive stock market returns. And during those positive recessions, the market rose an average of 9.8%, while GDP fell by 3%. Or in other words, half of the 30 recessions had no correlation with stock values at all. Now you may ask, Maslow, how can I protect myself during these troubling times or even earn money from it? To answer the first question, maintain your employment and have an emergency fund such as a high-yield savings account and short-term treasury notes. This will protect your assets in times of emergencies and ensure you have a backup plan in case things go awry. Now, for the second suggestion, keep on investing. Research has shown that the best approach to earning money in economic recessions is to do nothing for 20 years and to use a basic investment strategy like a dollar cost average and an index fund. It may not be as exciting as trying to time the market or chase short-term gains, but it's certainly effective. It's natural to wonder if it's a good idea to stay invested during economic recessions. But it's important to remember that things usually get worse before they get better. In fact, half of the S&P 500's best days in the past 20 years occurred during a bear market, and 34 of the best days occurred in the first 2 months of a bull market, before it was clear that a bull market had started. This means that investing during a recession can be lucrative, with the market rebounding and producing an average profit of 1.7% after a recession ends, and a 15.3% gain the following year. Since 1950, the S&P 500 has only finished lower at the end of the year 16 times, giving you a 79% chance of making money by investing in it. This means that you should simply pour everything into the S&P 500 at the start of the year and then wait. Real estate values will do the same. Many investors tend to follow the philosophy of buying high and selling low, which can lead to underperformance when investing. The Magellan Fund is an excellent example of this. The Magellan Fund, a well-known mutual fund, saw record high growth under Peter Lynch's management from 1977 to 1990. Despite the fund's success, the average investor lost money during this time due to purchasing the stock when it was expensive and selling after experiencing losses. This resulted in missing out on any following gains. To make the most money during a recession, it's important to follow proven techniques and avoid common mistakes. Investing shouldn't be viewed as a game or a source of enjoyment. It's a calculated risk, not gambling. Trying to beat the market by taking unnecessary risks is not a sign of a good investor. Although short-term prices may vary due to interest rates, supply, and demand, long-term values normally trend upward, and drawdowns often last just a few years before rebounding, which is why it is vital to continue working and generating money. Don't panic, don't sell, and don't speculate on risky investments. Instead, diversify your holdings and, most importantly, like and subscribe if you haven't already. Also, do not forget to click the bell icon to keep you posted on our new uploads. Thank you for watching, and we'll see you again in the next video.